Before you place your next trade, you need to hear this. Every trader wants control, but control is what destroys them. You felt that panic. The chart moves against you, and your brain whispers, "Do something. Anything." Your finger hovers over the mouse. Your heart pounds. The green candles seem to taunt you as they climb higher and higher, leaving you behind. You're not broken. Your brain is just wired for survival, not for wealth. Today, you'll finally understand why your mind trades against you, and more importantly, how the greatest investor who ever lived discovered the secret to holding winners when every instinct screams to sell. Warren Buffett learned this lesson at age 11 with a single trade that would haunt him for decades. But that mistake, that early defeat, became the foundation of a philosophy that would create more wealth than perhaps any other investment approach in history. What he discovered wasn't just about holding stocks. It was about rewiring the human brain to work with the market instead of against it. The story begins with a young boy, his sister, and $40 that would teach them both one of the toughest lessons the market offers. But first, you need to understand what's happening inside your head every time you see a winning position. Your brain treats every profitable trade like a lottery ticket. The moment you're up $50, $100, even $20, something ancient awakens. It's the same mechanism that kept your ancestors alive when they found food in the wild. Take what you can get. Don't risk losing it. Survival trumps everything. This isn't weakness. This is evolution. For thousands of years, the humans who grabbed immediate rewards lived longer than those who waited for better opportunities. The patient ones often missed out. The cautious ones stayed safer. Your DNA carries the memory of ancestors who survived by taking what they could get when they could get it. But the stock market isn't the wilderness. The rules are inverted. Here, patience feeds you. Impatience starves you. The market rewards those who can override their most basic instincts, who can sit still while every fiber of their being screams to act. Scientists call this the disposition effect. It's the proven tendency to sell winning investments too early and hold losing ones too long. Researchers studied 10,000 trading accounts over 6 years. The results were clear. 60% of all sales were winners, only 40% were losers. Traders systematically cut their flowers and watered their weeds. Think about your own trades. How many times have you sold a stock after a 10% gain, only to watch it climb another 50%? How many times have you held a losing position, convinced it would bounce back, while it continued to bleed your account dry? You're not alone. Professional fund managers do this too. Day traders, hedge fund managers, even seasoned investors with decades of experience fall into the same trap. The disposition effect doesn't discriminate. It feeds on human nature itself. But Warren Buffett found a way out, not through willpower, not through discipline alone, through a complete rewiring of how he thought about ownership, time, and value. His approach seems almost impossibly simple, yet it goes against every natural impulse we possess. The 11-year-old Buffett bought Citi Service preferred stock with his sister Doris. They paid $38 per share. Within days, the stock dropped to $27. Panic, fear, that sinking feeling in your stomach when red numbers stare back at you from the screen. But young Warren held. He waited. He watched the stock slowly climb back to $40. Then he sold. A modest profit. A safe exit. Relief flooded through him as he pocketed his gains and moved on to the next opportunity. The stock continued climbing. $45, $60, $100. It didn't stop until it hit $200 per share. The boy who would become the world's greatest investor had just learned the most expensive lesson of his life. He had been right about the company, right about the value, right about everything except one crucial detail. He sold too soon. That mistake burned itself into his memory. Not because of the money he lost, though, that stung, but because he realized something deeper, something that would reshape how he thought about investing forever. He had let fear make his decisions. Fear of losing his gains, fear of looking foolish, fear of being wrong. The market had taught him that being right about a stock and making money from it were two completely different skills. You could analyze perfectly, time your entry flawlessly, and still fail if you couldn't master the hardest part of all, holding on when you're winning. This is where most traders break, not when they're losing. Losses hurt, but they're expected. Everyone knows that trading involves risk. Everyone prepares mentally for red days. But winning? winning creates a different kind of pressure, the pressure to protect what you've gained, the pressure to prove you are smart, the pressure to avoid the regret of giving back profits. Your brain doesn't distinguish between a real loss and the possibility of a future loss. When you're up 50% on a position and you imagine it falling back to break even, your neural pathways fire as if the loss has already happened. The discomfort feels real. The fear feels justified. Selling feels like the only rational response. But here's what Buffett understood that most traders never will. The stock market isn't rational. It doesn't reward rational thinking. It rewards patient thinking, long-term thinking, the kind of thinking that can hold a position not for days or weeks, but for decades. When Buffett says his favorite holding period is forever, he's not being poetic. He's describing a fundamental truth about wealth creation. The biggest gains don't come from perfect entries or brilliant analysis. They come from doing nothing, from sitting on your hands while your winners compound year after year. Consider his investment in Coca-Cola. He bought his position in 1988. The stock has split multiple times since then. It has paid dividends every quarter. Those dividends have grown year after year. If you calculate the total return, including reinvested dividends, that position has generated returns that would make most traders weep with envy. But here's the crucial part. There were dozens of times when selling would have seemed smart. Market crashes, recessions, new competitors, health concerns about sugar, political changes, economic uncertainty. Every year brought new reasons to take profits, to reduce risk, to be prudent. Buffett held through all of it. Not because he was stubborn, not because he was lucky, but because he had rewired his brain to think differently about what it means to own a piece of a business. Most traders think they're buying numbers on a screen. Buffett thinks he's buying a piece of a company. When you own a piece of a company, you don't sell it just because someone offers you a higher price today than they offered yesterday. You sell it when the business fundamentals change, when the competitive advantages erode, when management makes decisions that threaten long-term value. This shift in perspective changes everything. This shift in perspective changes everything. Instead of watching price movements, you watch business performance. Instead of fearing short-term volatility, you welcome it as an opportunity to buy more shares at better prices. Instead of celebrating quick gains, you celebrate the slow, steady accumulation of wealth that only patience can provide. But rewiring your brain isn't easy. Every instinct fights against it. Every news headline tries to convince you that this time is different. Every market drop tests your resolve. Every rally tempts you to take profits while you can. The traders who succeed aren't the ones who never feel these impulses. They're the ones who feel them and still follow their long-term plan. They've trained themselves to recognize the difference between market noise and meaningful change. They've learned to guide their decisions instead of reacting emotionally. So how do you trade when your instincts want to pull you off course? How do you hold winners when every fiber of your being screams to sell? The answer lies not in fighting your nature, but in understanding it so deeply that you can work with it instead of against it. The first step to breaking free from your brain's grip is understanding why it holds on so tight. Your neural pathways were shaped long ago by ancestors who faced a simple choice. Take the resource in front of you now, or risk not having it later. Those who secured immediate rewards were often safer. Waiting for something better sometimes meant going without. Your trading account is that modern resource. Every profitable position triggers a similar ancient response. Your amygdala, the part of your brain that manages emotional reactions, doesn't understand stock charts. It only knows certainty and uncertainty. When you're up 20%, it sends the same message your ancestors relied on for survival. Protect what you have. But here's what your instinct cannot grasp. In the market, opportunities can expand the longer you let them grow. Long-term thinking creates rewards that short-term instincts can't visualize. The patient investor often benefits more than the reactive one. This creates a real conflict inside your mind. Your conscious analytical brain knows you should hold winners. Your instinctive protective brain views every unrealized gain as something that might disappear. The tug-of-war builds until something gives, usually your discipline. Think about your last winning trade. Remember that moment when you first saw green numbers. Relief washed over you. You weren't failing. You weren't lost. You were on the right track. But then something shifted. Relief became tension. What if it goes back to break even? What if you lose this gain? What if holding becomes the wrong move? That transition from relief to worry happened instantly. Your rational mind tries to stay in control, but it's competing with automatic systems that respond much faster. They're designed to keep you cautious, not to help you grow long-term wealth. The disposition effect isn't a flaw, it's a survival response operating in the wrong environment. Warren Buffett understood this through experience. After his city service mistake, he didn't just blame the market. He studied his own reactions. Why did he sell too early? What truly drove that decision? The answer wasn't in the numbers. It was internal. He realized he wasn't reacting to the company. He was reacting to his emotions. Fear overtook logic. Short-term relief overshadowed long-term potential. The market taught him that being right about a business isn't enough. You must also stay right. This insight changed his entire philosophy. Instead of resisting his emotional reactions, Buffett learned to analyze them. Instead of trying to eliminate fear, he used it as information. If he felt fear, it meant he cared about the position. That mattered. But fear also meant he needed to zoom out, slow down, and think bigger. He stopped asking, "What if I lose these gains?" and started asking, "What if this business keeps growing for the next decade?" That single shift changes everything. You stop reacting to price movements. You start responding to business performance. You stop worrying about green or red days. You start caring about long-term direction. This mental shift requires practice. Every time you feel the urge to take quick profits, pause. Ask yourself, am I selling because the fundamentals changed or because the price moved? Am I responding to analysis or to pressure? Most of the time, if you're honest, the urge to sell comes from emotion. Fear of loss, fear of regret, fear of giving back what you gained. These feelings disguise themselves as logic. Take profits while you can. A small gain is still a gain. It's better to be safe. These phrases sound smart, but they push you towards short-term decisions that sabotage long-term potential. Buffett's mindset requires redefining success. Most traders measure progress by weekly or monthly performance. Buffett measures it in years, sometimes decades. When you change your time frame, your entire interpretation of the market shifts. Daily movements stop being meaningful. Quarterly noise loses its power. Fear becomes manageable. Pressure becomes data, not danger. Consider Apple, one of Buffett's most brilliant investments. He began buying in early 2016. Many questioned the move. Commentators doubted the future of the iPhone. Analysts said the company was losing its edge. But Buffett wasn't thinking about quarterly sales. He was thinking about ecosystems, customer loyalty, brand power, and long-term value creation. Apple's stock moved up, down, sideways. There were macro shocks, supply chain issues, and regulatory fears. Many traders would have taken profits at various points. Buffett stayed. Not because he was oblivious, but because nothing had changed fundamentally. This single mindset, waiting until fundamentals change, is the difference between average gains and legendary ones. The Apple position has produced tens of billions in value for Berkshire. Those gains didn't come from clever timing. They came from letting time do the heavy lifting. But this is the hardest part for active traders to accept. Most wealth in markets is created by doing less, not more. Your brain hates that. It wants to act, to fix, to optimize. Doing nothing feels uncomfortable because it feels unproductive. But in markets, activity often destroys results. More trades equals more mistakes. More decisions equals more emotional pressure. More tinkering equals less compounding. Professional poker players understand this deeply. They fold most hands. They only act when the odds are clear. They don't try to force outcomes, they wait for opportunity. Successful investors do the same. But holding winners requires emotional tools you must build intentionally. You need position sizes that don't overwhelm your emotions. You need exit rules that aren't reactive. You need a philosophy that is stronger than temporary fear. Start with sizing. If you're risking so much that you feel overwhelmed, you won't hold long enough to benefit from compounding. If you're risking too little, you won't be engaged enough to learn. Then, define your exit criteria before you enter. Not based on random price targets, but on fundamental changes. Is the moat weakening? Is leadership deteriorating? Is the growth engine slowing? Has your original thesis changed? If fundamentals haven't changed, price movement alone isn't a reason to sell. Most traders forget why they bought something in the first place. They buy based on long-term logic, but sell based on short-term feelings. The market tests you every day. Your ability to ignore noise and focus on thesis determines the outcome of your trades, not your ability to predict price. Buffett's Disney story captures this perfectly. In 1966, he bought a significant stake. Within a year, he was up 50%, so he sold. At the time, it felt smart. Long term, it cost him billions. Not because he didn't understand the company, because he didn't wait long enough. He himself calls it one of his biggest mistakes. Not due to the profit he took, but due to the compounding he forfeited. This is the hidden danger of the disposition effect. Selling winners too early teaches you not to trust your own analysis. It erodes confidence. It reinforces bad habits. It conditions you to act on fear. To break this cycle, you must retrain your instincts. Celebrate holding, not selling. Measure process, not outcome. Learn to sit with discomfort instead of relieving it. That discomfort is a sign of growth. It means your brain is adjusting to a new standard of thinking. The market uses pressure to test your conviction. Your response determines whether you act like a trader or an owner. And owners, true owners, don't flinch at noise. Your answer determines everything. Do you sell because the pressure is uncomfortable? Or do you hold because the thesis remains intact? Do you trade your emotions? Or do you trust your analysis? The choice seems simple when you're calm and rational. But in the moment, when real money is on the line, when the market is testing your resolve, the choice becomes infinitely harder. That's when your preparation matters most. That's when your rules save you from yourself. The greatest traders aren't those who never feel fear. They're those who feel fear and act correctly anyway. They've trained themselves to recognize emotional signals without being controlled by them. They use fear as information, not instruction. When you feel the urge to sell a winner, that's valuable data. It tells you that you have something worth protecting. It tells you the market has moved in your favor. It tells you that your analysis was correct. None of those things are reasons to sell. They're reasons to hold. The greatest threat to your wealth isn't market crashes or economic collapse. It's the moment when you're finally winning. When the green numbers climb higher than you ever imagined. When your analysis proves correct and the market rewards your patience. That's when your brain becomes your enemy. The urge to sell winners isn't rational. It's primal. It comes from a place deeper than logic, older than civilization. Your ancestors survived by taking what they could get when they could get it. The hunter who found berries didn't wait to see if more might ripen tomorrow. He ate them immediately because tomorrow might never exist. Your DNA carries those survival instincts. Every profitable trade awakens them. Your amygdala doesn't understand compound returns or long-term wealth building. It only knows one rule: secure the resource before something takes it away. This is why you sell Apple Inc. at a 20% gain and watch it climb another 100%. This is why you take profits on Amazon.com Inc. after doubling your money and miss the next decade of growth. This is why you cut your flowers and water your weeds over and over again, wondering why wealth always seems to slip through your fingers. The market doesn't reward intelligence. It doesn't reward hard work or technical analysis or fundamental research. The market rewards one thing above all else: the ability to act against your deepest instincts when those instincts are wrong. Most traders never develop this ability. They remain prisoners of their own psychology, trapped in patterns that feel natural but destroy wealth systematically. They study charts for hours. They analyze earnings reports. They follow economic indicators. Then they sabotage themselves at the moment of truth because their brain mistakes progress for danger. Understanding this isn't enough. Knowledge without application is worthless. You need to rewire the neural pathways that govern your decision-making. You need to build new habits that override millions of years of evolution. You need to become comfortable with discomfort, patient with uncertainty, and calm in the face of success. This transformation doesn't happen overnight. It requires deliberate practice, conscious effort, and the willingness to sit with feelings that every instinct tells you to avoid. But the traders who make this journey, who learn to hold winners when holding feels impossible, discover something extraordinary. They find that wealth isn't created by perfect entries or brilliant analysis. Wealth is created by doing nothing, by sitting still while others panic, by holding positions that feel too good to be true until they become better than you ever imagined possible. Consider the psychology of a winning trade from the beginning. You buy a stock at $50. Your analysis suggests it's worth $70. You've done your homework, you understand the business, you believe in the management team, you're confident in your thesis. The stock sits at $50 for weeks. Nothing happens, your confidence wavers. Did you miss something? Are you wrong about the company? Should you cut your losses before they get worse? This is where many traders sell for small losses, convinced they made a mistake. But you hold. The stock moves to $55. Relief floods through you. You weren't wrong after all. The market is finally recognizing what you saw months ago. You're validated. You're smart. You're going to make money. Then something shifts. The relief becomes anxiety. What if it falls back to 50? What if you give back your gains? What if everyone realizes you just got lucky? The voice in your head grows louder. Take some profits. Protect what you've gained. Don't be greedy. At $60, the voice becomes a roar. You're up 20%. That's a great return. Most people would be thrilled with 20%. Why risk losing it? Why not take half off the table? Why not secure some gains and let the rest ride? This is the moment where most traders fail. Not because they lack knowledge or skill, but because they can't handle success. They mistake unrealized gains for money they might lose, instead of seeing them as evidence that their analysis was correct. The stock continues to $70, your original target. Everything you hoped for has come true. The temptation to sell becomes overwhelming. You've achieved your goal. You've proven your point. Why be greedy? Why risk turning a winner into a loser? But here's what you don't realize in that moment. Your original analysis was probably conservative. Great companies don't stop being great just because they reach your price target. If the fundamentals that drove your thesis remain intact, why would you sell just because the stock price went up? This is where Buffett's thinking diverges from the crowd. He doesn't set price targets based on technical analysis or arbitrary percentages. He evaluates businesses based on their ability to compound wealth over time. If a business can grow earnings at 15% annually, why would he sell after a 20% gain? Why trade away years of compounding for a single quarter's profits? But your brain doesn't think in decades. It thinks in moments. It sees the bird in the hand and ignores the flock in the bush. It celebrates small, certain gains while missing enormous probable ones. This short-sighted thinking isn't a character flaw. It's an evolutionary advantage that's become a modern disadvantage. In the ancestral environment, resources were scarce and competition was fierce. Taking what you could get when you could get it made perfect sense. Waiting for better opportunities often meant going without, but the stock market operates on different principles. Here, scarcity thinking leads to diminished opportunity, while abundance thinking creates lasting wealth. Here, the patient capital beats the impatient capital consistently over time. Here, the greatest risk isn't losing what you have, but missing what you could gain. The market didn't reward your ancestors for patience. It rewarded them for immediate action. But the market of today, the financial market, is the opposite. Here, the greatest rewards go to those who wait, those who trust their research, those who allow time to work its quiet magic. Breaking free from instinct requires structure. Start by reframing how you talk about your positions. Stop calling them trades. Start calling them ownership stakes. Because when you view yourself as an owner, you make owner decisions, not trader reactions. Stop thinking, should I sell because it went up? Start thinking, has the business changed? Stop evaluating your performance based on daily price movement. Start evaluating based on whether your thesis is still intact. And most importantly, stop celebrating selling winners. Start celebrating holding winners. Your brain must learn that holding a position is not doing nothing. Holding is active discipline. Holding is a decision. Holding is a strategy. Holding is strength. And the more you practice it, the more natural it becomes. Because eventually something incredible happens. The voice screaming, "Take profits," becomes quieter. The discomfort becomes familiar. The uncertainty becomes manageable. The urge to react loses its power. You begin acting from intention, not impulse. From analysis, not emotion. From conviction, not fear. And that is the mental shift that transforms a trader into an investor. Because here's the truth very few will ever accept. Wealth isn't created by what you buy. Wealth is created by what you're willing to hold. The market punishes impatience. It rewards endurance. It amplifies discipline. It exposes emotional weakness. It magnifies psychological strength. Every legendary investor in history has shared this same core lesson. Buffett, Munger, Lynch, Templeton, Bogle, Dando investors, compounding-focused fund managers. All of them built fortunes not by predicting the future, but by holding great businesses long enough for the future to reveal itself. And that future always takes longer than your instincts want to wait. So the question becomes, can you hold long enough? Can you sit through the noise? Can you silence the urge to react? Can you trust the thesis you once believed in? Can you stay committed when the candles go red, green again? Can you be the one who waits while everyone else reacts? Because the one who waits is the one who wins. Your brain will protest, your emotions will flare, your instincts will fight you. But every time you override the impulse to sell too early, every time you stick to your rules, every time you allow compounding to unfold, you're no longer trading like your ancestors. You're trading like a modern investor. You're stepping into the arena with patience as your weapon. You're becoming the kind of thinker who builds real, lasting wealth. This is what Buffett learned when he sold City Service too early. This is what he realized when he sold Disney too soon. This is what he corrected when he built Berkshire Hathaway. This is what he perfected with Coca-Cola. This is what he mastered with Apple. And this is what you can master too. Your journey from instinct-driven trader to conviction-driven investor begins with one simple moment. The moment you recognize the urge to sell a winner, and you choose to hold instead, because your analysis, not your impulse, deserves to lead. The next time you see those green numbers, and that familiar whisper says, "Take profits now," pause, breathe, ask the question that rewires everything. Has anything fundamentally changed? If the answer is no, you already know what to do. Because in the end, the greatest investors aren't the ones who avoid fear. They're the ones who hold their winners anyway.